Treasury bills, money market funds, bonds, fixed deposits, stocks. Have you ever heard these terms and be like, oh, more? Be like, this investment is not for me. Relax. Because I'm about to make it simple that you don't need to be a financial expert to know these things. You are welcome to making it simple with wisdom, where we take complicated money and business concepts and make it look ridiculously simple for you. Because investment is for everybody. Let's start with treasury bills. What is treasury bills? Waiting be treasury bills. Forget about the grammar. Treasury bills is basically you lending your money to the government for a short period of time. You give your money to the government uses it, and according to the terms of the treasury bills, you get your money back with returns. Very simple. How do I invest in treasury bills? You can invest through your banks. You can invest through a licensed stockbroker and other regulated investment channels. You choose the amount and the percentage available to you. And here's one important thing. There is no permanent or fixed percentage. Treasury bills returns changes depending on the auction and the maturity period. So don't listen to anybody who says there's a fixed percentage for treasury bill. No, there's no fixed percentage. And the second one, money market funds. This might sound complicating, but let me simplify it. Imagine 1,000 people bringing their money together instead of investing separately. A professional fund manager manages the pool and invests it into short-term instruments such as treasury bills and other money market investments according to the fund's mandate. You put in your money, the funds manager does the investing, and you make returns from it according to the fund's performance. And this is where it gets interesting. According to data from Nigeria, some money market funds recorded roughly 18 to 21% in return this year. For example, a top performing money market fund recorded 20.54% in returns. Let's make it real. For example, you put in 100,000 naira and you get a return of 20%. Annually, you are getting 20,000 naira as a profit. If you put in 500,000 naira, annually you are getting 100,000 naira. If you put in 1 million, annually you are getting 200,000. If you put in 5 million, you are getting 1 million naira annually. Just imagine you keep reinvesting. You keep reinvesting. And that is how money starts working for you. But listen carefully. The 20% is just an illustration. It's not a guaranteed return. And also money market funds, their returns changes. There's no fixed return. A performance of last year can be higher than the performance of this year. So last year better performance doesn't guarantee that this year will be better. That's how money market funds operate. Now, how do I invest in money market funds? You choose a SEC-regulated funds manager or an investment platform that is offering a money market fund. SEC means Security Exchange Commission. You open an account, you fund your account, and you invest. Some funds allow you to invest relatively small amount of money. In Nigeria, some list minimum of 5,000 naira subscription and subsequent investments of 1,000 naira. So no, you don't need to be a millionaire to start investing. The next one is bonds. Bond is basically lending money as well. You are lending money to a government or a company. They agree to pay you according to the terms of the bonds. The major difference is that bond can be a long-term investment than treasury bills. You can access bonds through licensed investment firms, banks, or broker, depending on the specific bond. Before you invest in bonds, understand this. Who are you lending to? How long is your money locked in? What returns are you receiving? What are the risks? And the next one is fixed deposit. This one is pretty straightforward. You give your bank money for a specified period of time, and they also give you return according to the terms. So if you have money in your account you are not using currently, you can ask your bank, what are your current fixed deposit rates? How long is the tenure? And what happens if I try to withdraw early? Don't just look at the returns or the profit. Understand the conditions. And the last one is stocks. Stocks are very different. When you buy shares, you are buying a small piece of a company. So if the company performs well, their share price rises. So your investment increases in value. Some companies even pay dividends. But unlike fixed income investment, your investment can also drop in value. It can fall if the company performs badly. So it has a higher growth potential and also a higher risk. You can invest through a licensed stockbroker or a regulated investment platform that gives you access to Nigerian stock market. So wisdom, which one should I invest in? That is the wrong first question. Your first question should be, what am I investing for? Do I need this money in the next 3 months, 5 months, 1 year, 5 years, 10 years? How much risk can I handle? How much money can I afford to invest? See, investing is not about putting your money in the investment that is bringing out the highest percentage. No. It is about putting the right money into the right investment for the right period. And also note, you don't need to learn all investment terms before you start building wealth. No. But you need to know what you are putting your money into. So start learning. Start small. Invest consistently and reinvest your returns. And give your money time to grow. Because wealth isn't only about how much money you make. It's also about what you do with the money you make. This is making it simple with wisdom. If there's any financial or business term you've heard that feels complicated in your head, drop it in the comments. I'll make it simple. See you in the next video.